Hey guys, in this video we're going to learn about the basics of taxes when investing. So first off, try to avoid as much taxes as possible. So to do that, invest first in a 401k or an IRA. So if you don't have a 401k, then a traditional IRA, then a Roth IRA, or if you have a 401k, then invest in that and then invest in a Roth IRA. And that way you can maximize your tax savings. Now next, before you go to the next thing, there's still other options to still further reduce your tax burden with educational IRAs and other options. There's several different things out there. Just look into them and see what works for you. And then after that, if you want to open up an individual brokerage account, you have to understand the taxes associated with that. So if you open an individual brokerage account, you buy a stock, and then you sell a stock within the same calendar year, that stock is going to be taxed at short-term gains. And so that's going to be taxed at ordinary income. And if you keep that same stock and you didn't sell it there and you held it for a full year, then you get taxed at long-term gains instead of short-term capital gains. You get taxed at long-term capital gains, which is 15%, a flat rate. And so that can be a significant savings. And another thing to consider are dividends and a few different subcategories of dividends even. What a dividend is, it's something that some companies pay at a quarterly, monthly, and even a special annually frequency. So a dividend is taxed also at a long-term capital gains rate, so that's going to be at 15%. Now, that's a qualified dividend. There's some dividends, like dividend that REIT pays, which is going to be taxed at ordinary income instead. So that's just something to consider depending on how high that yield is versus a more safe company that has a slightly lower dividend. You might want to choose that depending on, again, the risks and things like that. So a few things to mention when you have a loss. So if you sold a stock and you sold it at a loss, you're able to deduct that loss from any gains that you sold during that calendar year. Now, let's say you had no gains. You typically contribute up to $3,000 of losses to other income sources, like just your regular income. You can take up to $3,000 and apply that in that calendar year. And some people do something called harvesting losses for that year. One thing you want to consider and avoid is not rebuying that stock within 30 days, or that's going to be considered a wash sale, and you can't use those losses deducted from either gains or other wages that you earn in that year. And another thing to just avoid is that if you're new to investing, especially if you just are selling stocks, and especially if it's a short-term gain and you're only making $50 or $100 even, you want to just know that, so let's say you have to pay 30% in taxes, but then in addition, you have to pay for your taxes at the end of the year in terms of the software that you have. So if you have a simple tax situation, maybe you use TurboTax and it's free, or you pay only $30. But if you have investments, then you're probably going to have to pay up to $50 or more for that software, or pay someone else who's going to look at all your investments. They might charge more as well. So that's another $20+ that it's going to eat away at your investments. So not only 30%, but you might have that as well. So don't fall into the trap of making a quick sell of $30 and that's it, because you'll lose $10 for tax, and then you lose $20+ just to get the software of TurboTax that will allow you to account for your investments, and then you might end up being at a loss. So you don't want that to happen. A few more things to also consider is that if your company gave you any grants or RSUs, or if you contribute to employee stock purchase plan, then you also want to know that the price that you get your stocks at, that's all going to be generally at ordinary income. If you hold that stock for over a year, let's say that stock, you got that at $30 per share, and a year later it was at $60 a share. If you sell that, then you can get taxed at a long-term capital gains rate of 15%. And so that's significant, and so something to consider. Keep in mind, if you gained a grant but you didn't exercise it, then you're not going to gain that long-term capital gains rate by just sitting there not exercise. So there's certain things that you need to also factor in when dealing with these type of things. And so definitely contact your financial advisor if you're going to try to avoid certain taxes and get their opinion on how to do that best. Well guys, I hope you enjoyed this video, and just a friendly reminder, I'm not a professional financial advisor. Videos are for informational purposes only and entertainment value. I hope you enjoyed, and if you like this video and want more videos like this, don't forget to like and subscribe. I'll see you next time. Thanks for watching.